this week's market update. Currencies and bonds are the main focus. Technology stocks are under the spotlight in earnings season, and Brexit looms large again as talk revives of a leadership challenge in the UK. The big stories this week have been not equities but currencies and bonds. First, bonds. The pressure on the bond market continues this week. US Treasury yields, which move upwards as bond prices fall, hit their highest point for 4 years early this week, rising to 2.71% for the 10-year benchmark issue. It's not just in the US either. German 5-year notes briefly rose back into positive yield territory this week. These bonds saw their yield turn negative, essentially so high priced that investors are guaranteed a capital loss, in January 2015, and they've not been above zero since. The latest moves in bond yields are evidence that economic growth and the likelihood of consequent interest rate hikes are bringing the long bond bull market to a close. Indeed, technical analysts are getting excited about an apparent breach of the long and very consistent downtrend in the 10-year yield. No one knows exactly how the markets will react to this. So far, the well-flagged nature of the tightening and its modest nature has been taken calmly by investors. What's not clear is how long investors will stay so relaxed if the trend's reversal is confirmed. Also unclear is whether any unwinding of the bond bull market will spill over into the equity market and when that contagion might be triggered. This week's Federal Reserve policy meeting might usually be expected to have an impact on bond yields, but it's likely to be uneventful. Janet Yellen's final meeting as chair of the Fed will almost certainly leave short-term interest rates unchanged at between 1.25% and 1.5% following December's quarter-point hike. The March meeting is seen as most likely for the next rise, with traders putting the chance of another uptick in rates at more than 75%. Key to the Fed's deliberations will be this Friday's non-farm payrolls and, of course, wage inflation data. The second big story, currencies, was in focus at last week's Davos meeting of the great and the good, after conflicting messages from senior US politicians encouraged volatile trading in the dollar after a year of relative stability. The US currency has been notably weak so far in January, with the dollar index, which measures its value against a basket of other currencies, falling 3.7% so far this year, and that followed a 13% slide in 2017. The weakness of the dollar last year was one of the big market surprises, as most investors were positioned at the start of 2017 for a strong dollar on the back of rising US interest rates and a recovering US economy. The unexpected weakness of the dollar and the lack of volatility, which made it hard for traders to make money in forex deals, is thought to have contributed to this year's weak start. Traders who missed out last year have been determined to jump on the weak dollar bandwagon, making it almost a self-fulfilling prophecy so far in 2018. Another reason for the weakness of the US currency is the expected impact of Donald Trump's tax reforms, which were signed off by Congress before Christmas. In previous periods of large tax cuts, the dollar has tended to deteriorate on the back of a widening trade deficit. Whatever the reason, trading volumes have been high, with deals worth $500 billion taking place on one trading day, an unusually high level, especially for January. The final reason for dollar weakness has been the willingness of senior US politicians, including President Trump, but also Treasury Secretary Steven Mnuchin, to talk down the currency. This runs counter to US unofficial policy in recent decades, which has tended to support a strong dollar. Investors have been unwilling to bet against a White House which now seems to favour a weaker, more competitive currency. The flip side of a weak dollar has been sterling and euro strength. The euro hit a 3-year peak of just over $1.25, while the pound briefly climbed above $1.43, the highest level since shortly after the EU referendum in summer 2016. The yen too is firmer at 108 to the dollar. The dollar's weakness has been a positive for US equities, in the same way that the pound's weakness over the past 18 months buoyed the FTSE 100. Wall Street has now secured 14 record closes in January alone, adding to 2017's record number of new highs. On this side of the Atlantic, shares in both the UK and Europe have been on the back foot, thanks to less competitive currencies. Both the FTSE 100 and the Euro First 300 ended last week down. Another reason for the stock market's positive showing in America has been the broadly positive tone of corporate results and the comments from companies about how they will be impacted by the Trump tax reforms. This week's focus in earnings season is very much on the technology stocks which have driven the market higher, so investors will be looking for positive results to justify the current high level of the various US indices. Facebook kicks off the tech mini-season with analysts expecting a big jump in revenues and profits. Mobile ad sales have been strong. Also on Wednesday are results from eBay. Again, a rise in fourth quarter revenue and profits is anticipated. Thursday brings numbers from Apple, Alibaba, Alphabet and Amazon, and investors will be hoping that the results are likewise all A stars. Apple's figures for the 3 months to December will be the first to include sales of the new iPhone X. Net income is expected to be at least $19 billion, up from the previous quarterly record of $18 billion struck in 2015. Alibaba, the Chinese e-commerce group, has been investing heavily offline and overseas as its market at home becomes more saturated. All eyes will be on the Singles Day event in November. That's a kind of Chinese Black Friday. Google owner Alphabet is expected to have benefited from a rise in mobile search traffic and advertising sales, as well as a good contribution from YouTube. And Amazon will tell us how it fared in the crucial Black Friday and Christmas sales period. Now, politics is front of mind again on both sides of the Atlantic. Last week, Donald Trump went to Davos and presented an unexpectedly statesmanlike face to the great and the good attending the World Economic Forum. His soothing tone about America first not meaning America alone went down well with the global elite. Skeptics noted, however, that while the tone of the address was more emollient, the content remained notably insular. He remains largely uninterested in global cooperation. This week, we may well see a very different Trump on show in the annual State of the Union address. Unlike his Davos speech, this will be beamed to all of America in prime time, and he will certainly be speaking to his core supporters this time. On this side of the Atlantic, Theresa May faces yet another difficult week as speculation about a possible leadership challenge continues to circulate. Caught between the rock of Eurosceptic Tory MPs and the hard place of a more pro-Europe Parliament, she's still refusing to give anything away about her position on the proposed end state for EU-UK relations. She's apparently abandoned plans to present the UK's position before second phase negotiations are due to begin in March. Adding to her woes, a leaked ministerial briefing into the expected economic impact of various Brexit outcomes seems to confirm what the Remainers have long claimed, that any option will be more economically damaging than continued access to the single market and the customs union. Mrs May will therefore view her upcoming visit to China this week as a mixed blessing. It will get her away from the intrigue and the plotting for a few days, but she may well wonder what will await her on her return.